I briefly discussed dividends in the prior topic. Now we will go into more detail about what they are and the journal entries. Dividends are distributions to shareholders. When a company makes a lot of money, they will keep some in the business as retained earnings and distribute the rest to the shareholders. This is similar to earning interest. Companies are not required to pay dividends. The market price of the stock is affected by dividends in a few ways. Stock prices are sometimes higher for those companies that do pay dividends because they are more attractive to investors. Also, the market price fluctuates around the dividend dates to account for stock that will receive the dividend and ones that won't. In order for a company to pay a dividend, there needs to be a positive balance in retained earnings, and there must be enough cash on hand to make the payments. If a company did not earn money this year, they had a net loss. Then they legally cannot pay out dividends. For example, Tesla has recorded losses ever since the company started. Because of this, they have never paid out a dividend. There are four types of dividends: cash dividends, stock dividends, property dividends, and scrips, known as notes. The most common type is a cash dividend. Stock dividends happen as well, but not as often. We will only be covering cash and stock dividends in this course. I am going to show you an example of looking up dividends for a few companies. This is Yahoo Finance, and as you can see, the ticker symbol AAPL, which stands for Apple. If you scroll down slightly, you can see the line that says forward dividend and yield. The first number is the amount. Apple pays $3.28 per share. So if I own one share of Apple, I get $3.28. However, this is the annual amount based on the past year. Companies normally pay out the dividend quarterly, so I will get 25% of this every 3 months. The second number is the percentage. It is based on how much the shares cost. You can think of it like your interest rate. It is less than 1% here, so it's not too great. When comparing multiple companies to invest in, it is always best to go by the percentage. Let's look at another company to compare. Here is Target's information. As you can see, the dividend amount is $2.72. This is less than Apple, which was $3.28. However, the yield is higher. The $2.72 is a 2% return, almost 1.99%, while for Apple, it was under 1%. That is because Apple stock costs a lot more than Target stock. Even though the dividend amount is higher, it is actually less compared to how much you need to spend on one share. If I invest the exact same amount of money in both stocks, my return will actually be higher for Target. When making the journal entries, there are three dates to be aware of. The first date is the date of declaration. This is when the company announces their earnings for the quarter and declares the amount of money that will be distributed as a dividend. There is a journal entry that us accountants need to make on the declaration date. Since the company is announcing how much they will pay to shareholders, it is now a liability. The company can't go back on this declaration. The journal entry is a debit to retained earnings and a credit to common dividend payable. Remember that a company's earnings will go into retained earnings, and then dividends are paid from this account. This is why retained earnings is a debit. We are decreasing this account by the amount we are paying out in dividends. The account common dividend payable is being credited because it is a liability account. Liabilities increase on the credit side. The second date to take note of is the date of record. Investors need to be a shareholder by the record date in order to receive the dividend. This date is usually a few weeks after the declaration date. Potential investors have time to decide if they want to buy stock or not in time to receive the dividend. On the record date, there is no journal entry. We already know how much we are paying out from the declaration date. We just get the list of names on the record date. The final date is the date of payment. Just like it sounds, it is the date that the company pays their shareholders the dividends. On this date, the liability no longer exists and cash is paid out. The journal entry is a debit to common dividend payable. This is done to remove the liability off the books. The credit is the cash to indicate the cash amount that the company is paying out. The amounts for all these transactions are the same. I have an example to show you how these dates are indicated online. This is for Target. As you can see, the dividend date is September 10th, 2020. This is the payment date. The ex-dividend date is similar to the record date. The textbook does not cover this, but I want to so that you are aware of what it means. In order to own stock by the record date, you need to purchase the shares the day before the ex-dividend date. This means that if I want to receive the dividend payment on September 10th, then I would need to purchase the stock on August 17th or earlier. We're now going to take a look at stock dividends. These are the second most common besides cash dividends. This is when a company gives additional shares of stock to the shareholders instead of cash. I personally have never received a stock dividend, but I have friends that have. Stock dividends can be used to keep the market price of the stock affordable. This may be a better option for companies if they are tight on cash. When making journal entries, we need to be aware of the same 3 dividend dates. On the declaration date, we are still recording a liability, but the entries are a little more complicated. We still debit retained earnings, so that part is the same. The amount is the amount of shares the company has multiplied by the percent of shares they are giving out multiplied by the market price. We use the account common stock dividends distributable as a liability account. This amount is calculated by multiplying the number of shares by the percent and then by the par value. Since we are dealing with stock instead of cash, we need to use the paid-in capital account again. Remember, this account is the difference between the other 2 amounts. The next date is the date of record. As with cash dividends, there is no entry here. On the payment date, we need to remove the liability and pay out the stock. We debit the account common stock dividends distributable to remove the liability for the same amount we used on the declaration date. We credit common stock because that is what we are paying out, not cash this time. Our last slide for this topic is on stock splits. Just like the name sounds, this is when the stock splits. Shareholders will get additional shares of stock. There are also reverse stock splits, but that is rare. Stocks can split 2-for-1, 3-for-1, and so on. This really helps make the stock become more affordable. For example, Amazon's stock price is at over $3,000 a share. The average investor does not have $3,000 to spend on just one share. A stock split can lower the cost of each share, making it easier for the average investor to purchase. The good thing is that there is no journal entry for you to worry about, only the concept of what this is. Here is an example. If I have 10 shares of stock that is worth $200 each, what is my total equity or my total investment in the company? It would be $2,000. You would just multiply. Now let's assume there's a 2-for-1 stock split. This splits each share into 2 shares, but also cuts the price in half. What is the new value per share? It would only be half at $100 per share. How many shares would I own though? That would double. I would now have 20 shares instead of 10. What is my equity? You would multiply to get $2,000. As you can see, the equity stays the same. So a stock split does not put any current shareholder at an advantage or disadvantage. I have a short video clip to wrap up this topic about when Netflix did a stock split.
Netflix wants to make its red-hot stock more affordable, and that makes Netflix today's chart of the day. Now, it won't be quite as cheap as its monthly subscriptions, but Netflix shares will soon cost a lot less than $680. Netflix's board of directors has approved a 7-for-1 stock split at a time when its stock is trading at all-time highs. Now, the stock will begin trading at the post-split price on July 15th. Netflix was widely expected to split its stock after announcing plans to do so in April and then gaining shareholder approval to increase increase its number of authorized shares this month, which is a preliminary step in a split. Now, the last time Netflix split its stock was 2004. The video streaming company has enjoyed tremendous success lately, with shares climbing 58% over the last 12 months and trading at about $681 as of Tuesday's close. And based on that price, shares would be available for just under $100 after the split. Shares of Netflix popped higher to about $697 in after-hours trading. That's why Netflix is today's Chart of the Day. For The Street, I'm Jane King.